Today, we're looking at Palantir Technologies and its recent rise above $50. The stock jumped 15.5% after earnings and another 30% following the US elections, catching the eye, obviously, of investors. Is this the buying opportunity we've been waiting for, or should we consider other options? The company dropped their Q3 2024 earnings in early November, and they absolutely crushed it. We're talking about a 30% year-over-year revenue jump to $725.5 million, beating what analysts expected. Their earnings per share hit 10 cents, surpassing the 9-cent estimate. But here's where it gets really interesting. The US government revenue, up 40% year-over-year. Commercial revenue, even better, a 54% increase. When you see numbers like these, you start to understand why investors are getting excited. And speaking of excitement, Palantir's addition to the S&P 500 in September 2024 wasn't just a symbolic win. It put them on the radar of major institutional investors. Now, let's talk about what's happening on the daily chart, because this is where things get really interesting. That gap up on earnings wasn't just a one-day wonder. The bullish momentum from the US elections has pushed the price up by 45% since earnings. And there are two major reasons why this matters. First, and this is huge, Palantir has finally closed above $50. Now, I know what you're thinking. It's just a number, right? Wrong. This is a key psychological level that could have pushed price down. But instead of resistance, it could now become a springboard for higher prices. Second, and this is even bigger, Palantir has broken out of a 4-year consolidation. And here's some market wisdom for you. The longer the consolidation, the bigger the potential breakout. Let's look at Nvidia, for example. After its initial consolidation from IPO, it climbed 650% in its first uptrend. Could Palantir, another AI powerhouse, follow a similar path? But let's be smart about this. If you're thinking about getting in, you've got two options. The aggressive play is buying now, but here's the catch. You're risking a fake breakout. Price could reverse below $50, then below $45, putting you right back in consolidation. And nobody wants to sit in consolidation for months or even years. If you go aggressive, be smart with your stop loss. I'd suggest placing it below $45. Why? Because if the stock breaks through both $50 and its all-time high at $45, heading back into consolidation, that's clear signal the trend has failed. If the stock bounces off $50 or $45 and starts setting record highs, then the wide stop loss has done its job, which is not to get stopped out on a correction. The conservative play is to wait for a bull flag formation. We're talking about a pullback to $50, a bounce, and then a breakout to new highs. This pattern typically suggests the stock wants to move higher and gives you a clearer entry point. Looking ahead, what are our price targets? We're looking at $10 increments up to $100. So $60, $70, $80, $90, and that big $100 round number. Break through that, and we're talking $150 and $200 and so on as long-term targets. But here's the challenge that both aggressive and conservative approaches face. Palantir is unproven. Yes, it's got a market cap of $128 billion, making it the world's 130th most valuable company. But it has no history of uptrends. Since its IPO, it has been stuck in that 4-year consolidation until this recent climb out of consolidation. Compare that to Nvidia, which has 3 massive uptrends in its history: 2016 to 2018, a 650% gain, 2020 to 2021, a 1,000% gain, and then another 1,000% gain between 2022 and 2024. That's a track record you can trust. Palantir, we're in uncharted territory. But here's the thing, that's okay. It's just not ideal, and that means that you need to approach it without expectations and let the stock do its thing. It's really how you should approach any stock investment, without expectation. It's just that with stocks like Nvidia that have a history of performance, you can be quietly confident of cleaning up. With Palantir, you just have to hope that this is the start of the first big move. Here's our approach, which as an investor you will appreciate. Never risk more than 2%. Use a wide stop loss, as already mentioned, based on the stock's volatility. Follow with a trailing stop loss as it moves up. And here's the magic. As the stock rises, we compound by buying more, but only after removing risk on the previous position. It's strategic growth without adding any further risk to the portfolio. Smart, right? Okay, now let's dive deeper into what's driving Palantir's momentum, because this is crucial for understanding its potential. The company's CEO, Alexandra Karp, has been talking about unrelenting AI demand, and this isn't just corporate speak. Palantir's AI platforms are gaining serious traction across industries, and here's why this matters. Think about what's happening in the AI space right now. Every major company is scrambling to integrate AI into their operations. Palantir isn't just riding the wave, they're helping to create it. Their Foundry and Apollo platforms are becoming essential tools for enterprises looking to harness the power of AI and data integration. But here's what makes Palantir particularly interesting in the AI space. Unlike many companies that are just now jumping on the AI bandwagon, Palantir has been developing these capabilities for years. They've been working with some of the most demanding clients in the world, government agencies and large corporations that require sophisticated data analytics solutions. Looking ahead to 2025, what could drive Palantir to $100? Several factors need to align. First, they need to maintain that high revenue growth we're seeing. Their AI offerings need to continue dominating the data analytics space, and they need to keep expanding their commercial contracts and international presence. Okay, so let's break down the potential catalysts that could push Palantir higher. First up, strategic acquisitions and partnerships could open up new revenue streams. Imagine Palantir acquiring companies that complement their existing technology or forming alliances that broaden their reach. This could make them even more attractive to enterprise clients. Then their profit margins are improving, and this is crucial. Investors love growth companies, but they love profitable growth companies even more. Palantir's recent positive earnings per share reports suggest they're on the right path. And then there's the broader AI sector growth that could lift all boats, and Palantir is positioned to be one of the biggest beneficiaries. As more companies realize they need AI solutions, Palantir's proven track record could make them a go-to provider. But let's be real, there are challenges too. The high valuation concerns some analysts. Their dependence on government contracts could be risky. And let's not forget the competitive AI and data analytics market they're operating in. Some critics point to ethical and privacy concerns surrounding Palantir's technology, particularly in government surveillance and law enforcement applications. This could lead to regulatory scrutiny and public backlash. There's also the scalability question. Palantir's solutions often require significant customization for each client. While this ensures quality, it can limit how quickly they can expand their customer base and achieve economies of scale. Palantir is showing incredible potential, but it requires smart positioning and risk management. Whether you choose the aggressive or conservative approach, remember these key principles. Cut your losers short, let your winners run, and always respect the trend. A tech stock has recently added $150 billion to its market cap and seen a 30% increase this year. No doubt where Palantir hopes to be. The company in question is Google, and its recent performance could lead to new record highs. Watch this video to decide if this stock belongs in your portfolio.